When you watch a SpaceX rocket launch, you're witnessing pure, unforgiving physics. There is no hiding the math, and the engineers know exactly what is happening inside that machine. However, if you examine the paperwork behind the SpaceX IPO of June 13, 2026, the physics of reality simply vanish. We are currently looking at a financial landscape that completely defies the gravity of traditional valuation. We are looking under the hood of what is officially the largest initial public offering in human history. Opening with an unfathomable $1.77 trillion to $2 trillion market valuation, this IPO officially makes Elon Musk the world's first trillionaire on paper. On the surface, humanity's leap to the stars is now backed by the public market. But our mission is to ask a critical question. Is this the greatest financial opportunity of our lifetime, or a brilliantly disguised, legally sanctioned scam? Even if you have not bought a single share directly, your 401k or pension fund is likely already entangled in this web. To understand if an investment makes sense, you first have to know what you're actually buying. You would think it is a rocket company, but the details lie in the registration statement document filed with the SEC. Traditional aerospace companies such as Boeing or Virgin Galactic use the industry code 3760 for spacecraft and aircraft manufacturing. SpaceX, despite building 400-foot steel rockets that catch themselves in midair, completely bypassed that classification. Instead, they filed under code 737s, which is designated for computer programming and data processing. This single classification is the foundation of their valuation strategy because it sets up their total addressable market TAM. In the prospectus, SpaceX claims a massive TAM of $28.5 trillion, roughly the size of the entire US GDP. Here is where the paperwork illusion takes shape. Out of that $28.5 trillion pitch to investors, only about 15% is actually related to space rockets and Starlink connectivity. A staggering 85% of their pitch, amounting to $26.5 trillion is entirely based on artificial intelligence. It is like buying a famous, wildly successful pizza shop where the owner claims 85% of the valuation comes from a massive crypto mining rig plugged into the back room. You're essentially investing in xAI, Musk's AI company wrapped in a SpaceX shell. To understand this multi-trillion-dollar pitch, we have to examine the dual reality of SpaceX's balance sheet. Starlink is a phenomenal business operating as a near monopoly in satellite internet. However, xAI tells a very different story. In 2024, SpaceX generated a net income of $791 million. In 2025, SpaceX posted a massive net loss of $4.9 billion, and in the first quarter of 2026 lost an additional $4.2 billion in just 3 months. What caused a nearly $5 billion swing into the red? It all comes back to that metaphorical crypto rig. In February of 2026, SpaceX acquired Musk's xAI for $250 billion in stock. xAI is bleeding cash at an unprecedented rate. They are losing approximately $2 for every $1 they earn. The AI division burns through about $28 million every single day. Because of this, capital expenditure skyrocketed from a manageable 42% of revenue to an alarming 215%. Why would a business effectively printing money intentionally absorb a cash-burning startup right before asking the public for funds? Prominent short sellers, including Jim Chanos, are comparing the mechanics of this IPO to the Enron era, and that is not a good comparison. Originally, the IPO prospectus pitched xAI as a high-margin software business selling access to their Grok AI model. Right before the IPO, they executed a 180-degree pivot to a lower-margin neocloud model. This involves buying massive amounts of NVIDIA chips and leasing them out to companies like Google and Anthropic. But sources indicate xAI fundamentally botched the design of their mega data center. AI training requires massive parallel processing, but they allegedly mixed 3 entirely different types of GPUs in the same network. The fastest chips finished their work and sat idle waiting for older chips to catch up, creating a massive bottleneck. The entire system ran at a miserable 11% capacity, rendering it utterly useless for training their Grok model. Realizing they could not use it, xAI rented the fragmented space to Anthropic just to salvage cash flow, a bailout for an engineering mistake. The Google deal is even more concerning. If you dig into the filings, Google quietly holds a 6% ownership stake in xAI. Google is paying xAI for server space, injecting revenue right before the IPO, while simultaneously owning a piece of the company receiving that revenue. This appears to be circular financing, moving money between related entities to artificially inflate growth numbers. To hide the resulting cash burn, SpaceX utilizes a legal but highly distortive GAAP accounting trick regarding capital expenditures. When SpaceX buys $1 billion in chips, NVIDIA logs 100% of it as immediate revenue. SpaceX, however, amortizes that massive expense over 5 to 10 years on its books. It is like buying a $10 million mansion on a 10-year payment plan, but telling everyone your living expenses are only $1 million a year, deliberately hiding the massive debt you just took on. It creates a temporary illusion of economic growth and liquidity while deferring the true financial debts to the future. Despite bleeding financials and a data center running at 11% capacity, the stock price rocketed from $135 to over $160 on opening day and even more currently. It is currently trading at an absurd 110 times revenue, vastly overshadowing Tesla's premium of 14 times revenue. This was pulled off through structural manipulation and manufactured scarcity. The supply squeeze. The SEC standard requires newly public companies to list at least 10% of their shares to ensure accurate price discovery. SpaceX obtained a waiver to float only 5%, about 555 million shares, intentionally choking supply. The forced demand. Musk's team successfully lobbied to waive the standard one-year seasoning period for inclusion in the NASDAQ 100. By fast-tracking into the index on day one, passive index funds were legally forced to blindly buy $30 to $50 billion worth of SpaceX stock, regardless of its underlying value. Fortunately, the Standard & Poor's 500 rejected SpaceX. The Standard & Poor's 500 has strict rules regarding GAAP profitability, and xAI's massive losses disqualified them. That decision alone saved roughly $14 billion in passive funds from falling into the trap. Yet everyday retail investors are treating this stock like a speculative crypto coin. Independent analysts at Morningstar valued the stock at roughly $63, but people are happily paying over $160, banking entirely on the Musk factor and hoping he replicates Tesla's historic 44% annual compounded returns. For those willingly throwing their money at this, there is a massive trap buried in the registration statement regarding corporate governance. The shares being sold to the public are Class A shares, granting 1 vote per share. Musk holds Class B shares, granting 10 votes per share. Even after this multi-trillion-dollar IPO, Musk retains 83% to 84% of the total voting power. The legal documents explicitly state that Musk cannot be removed as head of SpaceX without his own consent. If you buy the stock, you are not buying a voice. You are handing your cash over to a dictator. You are funding his Mars ambitions and AI experiments with absolutely zero legal recourse if he burns it all to the ground. SpaceX is undisputedly a marvel of modern engineering. Landing reusable rockets backward on ships and blanketing the Earth in satellite internet are truly incredible achievements, but as a financial vehicle, it has morphed into a Trojan horse. It is a rocket company carrying a cash-hemorrhaging AI startup, propped up by circular deals, accounting mismatches, and forced index fund buying. It leaves us with a chilling thought. If a single individual can rewrite the deeply entrenched rules of Wall Street just by leveraging the sheer gravity of his fame, what does that mean for the future of public markets? Are we entering an era where the math simply no longer matters, and the stock market is just a popularity contest funded by our collective retirement accounts? The physical rockets might obey gravity, but the financials certainly do not. In a nutshell, the SpaceX IPO is a highly engineered bailout mechanism. It packages a functional, monopolistic space company with a massively unprofitable artificial intelligence company. Utilizing manufactured scarcity and SEC rule waivers, it offloads billions in artificial intelligence debt onto the investing general public and retirement funds, while early Wall Street insiders make a profit. If you liked this video, found it amusing, or in any other way, let others know by giving a like, subscribing, and/or leaving your comment. Thank you.